Most people who go broke from debt and most people who get rich from debt sign the exact same kind of loan. That's not an exaggeration, that's just true. Take two people, same bank, same week, same loan amount, same interest rate. Nothing on either contract tells you which one is about to lose everything and which one is about to get ahead. A banker looking at both applications side by side couldn't tell you either. A year and a half later, one of them has lost the asset the loan was tied to. The other one used that same loan to walk away with almost double what they borrowed. Same paperwork, same rate, same bank. Opposite outcomes. So before you assume it, no, it wasn't the size of the loan. We already said that was identical. And no, it wasn't the interest rate either. Rule that one out too. Whichever number you just guessed in your head, it's not the one that decided this. There is exactly one number sitting underneath every loan that determines which of these two people you become. Nobody explains it to you when you sign. It's not printed anywhere on the contract, and most people go their entire lives never once calculating it. Here's why this is worth staying for. This isn't a story about two people you'll never meet. This number already exists inside your own debt right now. Your credit card, your car payment, your mortgage if you have one. And before this video ends, you are going to calculate it yourself, on your own numbers, and know immediately which side of it you're standing on. I'm not handing you the number yet though, and that's deliberate. Said out loud right now, it would just be a term that means nothing. You need to see what it's built from first, or it won't stick. Hi viewers, quick one before we continue, and it's an easy one. Right now, in your own life, is debt something you actively avoid, or something you actively use? Drop your honest answer in the comments. No wrong answer, and it matters for where this is going. So let's strip this down to what a loan actually is, underneath all the fear built around it. A loan is renting money. Nothing more dramatic than that. You take a sum that isn't yours, you pay a fee for the time you hold it, and eventually you give it back. The interest rate is simply the rent. Seen that way, one question becomes unavoidable, the only question that was ever going to matter. While you're renting that money, is it earning more than the rent is costing you? That single question is exactly where our two borrowers split apart without either of them realizing it. One rented the money and let it sit, quietly costing them more every month it went untouched. The other rented the identical sum and immediately pointed it somewhere that paid back more than the rent. The distance between those two choices has a name, and it's the entire reason one of them lost the asset, while the other one used the same debt to build wealth. That name, and the one number sitting on top of it, is exactly where we're headed next. That gap between what borrowed money earns and what it costs to hold. The rich have a word for it. They call it the spread, and once you see it, you cannot unsee it. If you borrow money that earns you 7% and the rent on that money is 4%, you didn't just make money. You kept the difference between what it cost and what it paid. 3% on money that was never yours to begin with. That 3% is the spread, and the spread is the entire game. But the spread by itself isn't the whole number. There's a second piece, and this is the part almost nobody puts together. Your actual return on your own cash isn't just the spread, it's the spread multiplied by how many dollars you're controlling for every dollar of your own money you put in. Say that again slowly. Spread times leverage. That's it. That's the number sitting underneath every loan you will ever sign. Two people can take the exact same spread, and if one of them is controlling $10 for every dollar of their own, and the other is controlling 100, they are not playing the same game anymore, even though the rate on their paperwork is identical. A rich person doesn't look at a loan and think, how fast can I pay this off? They look at the same loan and ask two questions. What's the spread? And how many dollars can I control with it? Same contract, completely different question. You're going to watch that question answered 5 different ways over the next few minutes. Some of them you can run with the money already sitting in your bank account today. Some of them you genuinely cannot. Not yet. I'll tell you honestly which is which as we go, because pretending a billionaire's strategy is something you can copy on a Tuesday afternoon would be dishonest. But you need to see the big versions of this, because the small ones only make sense once you have. Start with the oldest version of this trick there is, one that's been running quietly under ordinary businesses for centuries. Picture someone who wants to sell furniture. Nothing exotic. Steady demand, thin margins, simple business. The way most people imagine this working is that you fly somewhere, buy a container of furniture with your own money, ship it home, and hope it sells. Your cash is now sitting inside a warehouse for months, doing nothing but waiting. But that's not how the people actually running this game do it. Manufacturers, especially overseas ones, will hand over the product on terms. 30 days, 60, 90, you get the goods now, and you pay for them later. They are lending you the inventory. They are your bank, and the product itself is the loan. Now run the number on that. You sell the furniture before the bill is even due. Customers pay you pay the factory, and you keep the gap between the two. So how much of your own money was actually in that deal? None of it. Zero, which means your leverage in this deal isn't 5 to 1 or 10 to 1. Divide anything by zero of your own dollars, and the number goes to infinity. The spread might be small, just your markup, but multiply a small spread by infinite leverage, and the return on your own cash becomes enormous. This is why people who are good at selling rarely worry about having money. They were never renting money in the traditional sense at all. They were renting terms. And you don't need a factory overseas to use this. A 0% introductory card floating your first batch of inventory. A supplier who gives you 30 days. A customer who pays a deposit before you've spent $1 of your own. Same mechanism, running quietly, at a smaller size. And we'll come back to the version of this almost anyone watching right now can use later in this video. Number 2 is where most people's math actually goes wrong, so let's slow down and run it properly. A property comes up for sale, $425,000. It's tired and overlooked. Nobody wants it, which is exactly why it's priced that way. You put 20% down, $85,000, and take a mortgage for the remaining $340,000. Then you spend $40,000 fixing it up. At this point, your own cash sitting inside this deal is $125,000. The down payment plus the renovation. The property gets fixed up. People actually want to live in it now. The market values it at $610,000. You go back to the bank and refinance, pulling a new loan at 80% of that new value. $488,000. You use that to pay off your original $340,000 mortgage, and you walk away with the difference in cash, $148,000. Here's where most finance channels get the arithmetic wrong. They'll tell you your profit is that $148,000 minus your $40,000 renovation, $108,000. That is not what actually happened, and the real answer is better than that. You put $125,000 of your own money into this deal. You just pulled $148,000 back out. Every dollar you put in came back to you, plus a little more, and you still own a $610,000 property, sitting on roughly $122,000 of equity you can now rent out. Run the number again. How much of your own cash is left in this deal at the end? Nothing. You took all of it back. So what's your return on your own money? You're not dividing by $125,000 anymore. You're dividing by zero. That's an infinite return, and it's the actual reason investors chase this strategy so aggressively. It was never really about the profit. It's that you got your entire down payment back and kept the asset anyway. Now honestly, this isn't free. Your new loan is bigger. You went from owing $340,000 to owing $488,000, and at today's mortgage rates, sitting around 6.5%, that's a meaningfully larger monthly payment. Refinancing also costs you another 2 to 5% in closing fees. So the entire strategy only works if the rent this property brings in actually covers that new, larger payment. with room to spare. The refinance was never the hard part. Finding a property that genuinely cash flows after all of it, that's the part nobody sells a course on. And this one, unlike what's coming next, is genuinely reachable. People with a lot less money than you'd assume are doing exactly this, right now, in ordinary neighborhoods. Because now, we climb a level higher, into the strategy sitting behind every headline you've ever read about a billionaire who somehow pays almost nothing in income tax. It isn't a loophole someone quietly slipped into the tax code. It's 3 completely ordinary rules, stacked on top of each other. And once you see the stack, you cannot unsee it. Step 1 is buy. You own things that go up in value: stock, a business, property. On paper, you're worth a fortune, but paper gains aren't taxed. You only owe anything the moment you sell. So the first rule is almost insultingly simple: don't sell. Selling is what triggers the bill, but you still need money to actually live your life. So step 2 is borrow. Instead of selling the stock and paying tax on the gain, you go to a bank or brokerage and borrow against it. A real financial product called a securities-backed line of credit. You pledge your portfolio as collateral, and they hand you cash. Right now, those loans run somewhere around 5.5% to 7%, with the lowest rates going to the very largest portfolios. Now weigh that against the number we built earlier. Your assets are growing around 7% a year. The loan against them costs somewhere around 6%. The spread is still positive, and you never sold a single share, which means you never triggered $1 of capital gains tax. And how much would that tax have actually been? Once you add the extra investment tax that kicks in at higher incomes, the top rate on long-term gains lands close to 24%. So borrowing at 6% to avoid handing over close to 24% isn't just convenient, it's the entire point of the strategy. Then comes step 3, and this is the cold part: die. Under current law, when you pass away, whoever inherits your assets receives them at what's called a stepped-up basis. Every gain you spent a lifetime never selling, and therefore never paying tax on, is simply erased from the record. The value resets to today's market price. Your heirs inherit the asset. The loan gets paid off from the estate, and the growth that was never taxed once never gets taxed at all. This single rule is estimated to cost the government tens of billions of dollars a year in taxes nobody ever collects. And before you assume the estate itself just gets taxed instead, as of this year, an individual can pass on $15 million completely tax-free, $30 million for a married couple. For almost everyone using this strategy, that final step is clean too. Buy, never sell, borrow to live, die, and the gains disappear. That's the machine. I'll be straight with you. This one isn't for you. Not today. You need a serious pile of appreciated assets before a bank hands you that kind of credit line. But you needed to see it, because a smaller, very real version of this exact idea is coming in a few minutes, and it's one you can actually run. Now, remember our 2 neighbors from the very beginning. Same loan, same rate. One of them ended up buried. Let's finally go back and find out why. Leverage cuts in both directions. That's the part nobody tells you when they're excited about the upside. A positive spread, multiplied, becomes a fortune. A negative spread, multiplied the exact same way, becomes a disaster. Our first neighbor borrowed money and put it somewhere that quietly cost more than it earned. Maybe it just sat there. Maybe it went towards something that lost value. Every month, the rent on that money kept accumulating, while whatever it was, funding kept shrinking. The gap between the two didn't stay small. It compounded, multiplied by how many borrowed dollars they were carrying. That small negative number turned into the very hole they eventually couldn't climb out of. Same equation, same formula, just pointed the wrong direction. And there's a version of borrowed money that turns this from a mistake into something closer to a trap. The securities line of credit we just talked about has one real danger built into it. Lenders don't hand you $1 for every dollar of stock you pledge. They give you somewhere between half and 90% of it, and they watch it closely. If the market drops and your collateral loses value, they can demand you add more cash or more stock immediately, or they sell what you pledged out from under you to cover the loan. That's called a margin call, and it's the moment leverage stops being a tool and starts being a threat. There's an even sharper version of this most people should simply stay away from. It's called short selling, borrowing in reverse. Instead of borrowing money, you borrow a share of stock, sell it immediately, and hope the price falls so you can buy it back cheaper and pocket the gap. When you buy a stock the normal way, the worst that can happen is it falls to zero and you lose what you put in. When you short a stock, there is no ceiling. If the price keeps climbing, your losses keep climbing right alongside it, with nothing to stop them. Same equation as everything else in this video, except here, the spread can go infinitely negative. You don't need to use this, you just need to recognize it when you see it. So let's come back down to the version that's waiting for absolutely everyone watching right now. This is the small, everyday mirror of the very first trick, the furniture seller borrowing product instead of paying cash. Except this time, instead of a factory, it's a credit card company lending you money at 0%. Right now, several of the major card issuers are offering genuine 0% balance transfer periods running 18 to 21 months, with a one-time transfer fee somewhere around 3 to 5%. That fee is the only real cost. Run the number on that. You are renting a chunk of money for roughly 3% total for close to 2 years. If whatever you do with that money clears 3% over 2 years, an extremely low bar, you keep the spread. But the version of this that actually matters isn't some clever investment scheme. It's the boring, obvious one. Moving a balance off a card charging you 24% a year onto one charging 0. The spread there isn't small. You're not trying to earn 3%. You're erasing a 24% cost and paying 3 to do it. That's a guaranteed return most investments on earth can't touch. This is the exact same mechanism as the billionaire borrowing against their portfolio. Borrow cheap, deploy it, keep the difference. The only thing separating the two of you is the size of the number involved. Which brings us to the one lever sitting underneath every single strategy in this video. The one absolutely anyone watching can start moving today. Go back to the spread. It's what your money earns minus what it costs you. Most people spend their whole lives obsessing over the earning side. The wealthy spend far more energy on the cost side because your interest rate isn't fixed. It's negotiable. And every fraction of a point you knock off, it goes straight into your spread. The single biggest lever on what your money costs you is your credit score. The national average sits around 715 right now. The gap between an average score and an excellent one isn't cosmetic. It's several percentage points on every loan you take out for the rest of your life. On a mortgage, a car, a business line of credit. Those points compound into tens, sometimes hundreds of thousands of dollars over time. The wealthy don't have access to some secret lender. They have access to cheaper money because they made themselves cheap to lend to, and that door is open to you too. So here's everything we just walked through, collapsed into one line. Debt was never the enemy. Debt is rented money, and the only question worth asking is whether what you do with it earns more than the rent costs. Get that one inequality pointed the right way, and debt stops being the thing that owns you and becomes the thing you own. Two people, same loan, same rate. One of them spent their life terrified of debt and stayed safe, but stayed still. The other one asked a different question. Not how fast can I pay this off, but what's the spread, and how much can I control with it? And that one question quietly changed everything that came after. You now know the number they were running without ever saying it out loud. If this changed the way you see the debt sitting in your own life right now, that's exactly what this channel is here to do. Like this video, share it with someone who needs to hear it, and subscribe, because next time, we go even deeper into the number you just learned to run.